if you don't leave the fundamentals of investing and stay very disciplined around it, and I would say we stay even more disciplined around it today than 12 years ago or 13 years ago when HPE started, I think you can sleep always pretty well, that you at least make a solid or very good return regardless of time.
Hello and welcome to a new episode of Private Markets Unleashed, the podcast that provides you with exciting insights into the private markets. In this week's episode of Private Markets Unleashed, we are delighted to welcome Tim van Delden, founder and managing partner at HPE Growth. Tim and myself, we had the chance in this week's episode to talk about the successful founding story of HPE being a private equity fund located in Düsseldorf and Amsterdam. Next to that, of course, we looked into how AI is impacting the selection process of companies. And of course, we also discussed how the democratization of private markets is evolving. Have fun listening and let's go. So, hello, Tim. Nice to have you here today. It's a pleasure.
Thanks, Philip. Thanks for having me.
Yes.
Looking forward.
We need to thank Jochen for introducing us. He's the real reason why we both find together and we do the podcast today.
Yeah, absolutely. Special thanks to Jochen Rathaus.
So, really happy that you have the time to join us here for our next episode of Private Markets Unleashed. Maybe we straight jump in and you give us a short introduction about yourself.
Yeah, sure. Thank you very much. Look, I was born and raised, I'm a countryside boy. I was born and raised in the German Münsterland, how it's called. It's a little bit north of Düsseldorf. Um, Before I had the great privilege to go to a boarding school, and really enjoyed the time there. Before then, uh, having first my roots going into mechanical engineering. My family has an industrial company background. Before then, later pivoting into the finance world, and had great mentors in my career, which gave me at some stage also the right opportunity to start my own business, which I think we talk a little bit later about.
Yes, of course we will.
Yeah.
So, of course, I learned already that you traveled a lot over the past weeks, and it's of course always interesting for the start to learn a bit about the perspective on the market. So, how do you see the private equity landscape today, M&A market, and fundraising, of course, as well? I think quite important, right?
And look, we all know, at least I'm doing now my job for 25 years, the market comes and goes in cycles. I feel we're definitely in an upcycle again from many different point of views. I think in our industry, the private equity markets, not only in Europe, but say in Europe, North America, but also in Asia, were very much brought down by some form what I would call a liquidity crunch. The years 2019, 20, 21 were stellar years, very high valuations, many exits, deals happened in 3 weeks. Um, but I think then 22 and 23 was really difficult years, no exits taking place, which makes then also LPs closing their pockets for new allocations if there's no money reflow. It was a clear flight to profitability because it was clear that private markets stop functioning. So it's not clear if you find follow-on financing, which then calls up then the risk people and large institutional investors, which makes the pockets even more closed. So we were really in a negative spiral. And that is, I feel, we have broken through. You see a huge lineup of an M&A activity in the markets to be seen what is really happening. But speaking ourselves, we have two companies in exit mode, which have very strong traction. So, and if I take that a little bit as representative, and also what we hear from other befriended private equity firms, there seems to be in the second half of the year several exits starting again. And as you know, there's also large IPOs rumored of Stripe or Klarna, to name just two of them, for second half this year or first half next year. I think we can be optimistic that 2024 is called it the transitional year from a negative spiral back to a positive spiral, with then really allocations and more like normal functioning private markets as of 25.
That's, great news, and especially important to hear that from someone that is really in the market and sees also, like, let's say, the transactions being prepared. And that brings us basically to the main topic of today's episode. What are you doing today, and what's your fund about with HPE Growth?
Um, Look, generally, in my background, what you would call I'm a digital guy. As you know, when you structure private equity fund products or when you start your own firm, you can only sell what you have a track record in. And my track record is definitely terminology has changed. So I started my career, maybe to do that very briefly, with Morgan Stanley, classical and M&A on the M&A execution side. So hardcore investment banking. Before then, joining General Atlantic Partners, which is today one of the largest growth investors in the world, with more than 90 billion asset under management. And then I had also the opportunity to run in Europe for 3 years a pretty sizable hedge fund before then starting my own platform back in tech growth investing. So, but at General Atlantic, it was back called then soft tech. And these days, these things are rather called digital. Means we focus, or I focus very much on investing in scale up companies that have their business model or their earnings model purely centered around digital business models, which very often then goes back to software, transaction platforms, marketplaces, etc., etc.
That's, of course, the thing for the future. It's already something you're doing since quite a lot of years, but I think the trend still goes in this direction. Um, how would you describe also in terms of the, let's say, current market developments, the effect of the multiples and company evaluations when you see the explanations of or examples of your current companies in the exit mode and things like that? So maybe give us a bit of information in terms of that.
No, sure. Look, as said, financial markets, not only the private markets, very often happen in cycles. So there are cycles where valuations are a bit too high, call it the hype cycle, and but you have also sometimes valuations where multiples are really too strongly depressed of really where the value of companies is. Um, Generally, I think a general observation is that there is always a time lag between public markets move first and there's a time lag till private markets start accepting or embedding these type of new multiples. The time lag typically is 9 to 12 months, um, and that is, I would say, more 12 months on the downward cycle and 9 months on the upward cycle. So everyone is faster prepared to clearly accept higher valuations when it's about from the entrepreneur side, but also people are signing up to it because people are on the fear of missing out a positive cycle. But this time lag is also the reason why in 2022 not many deals happened because 21 valuations were stellar high, then capital markets came down, and it took really the 9 to 12 months till there was again a matchmaking between bid and ask. How we would say in public markets, you have also in private markets bid and ask prices. They need to fit together, and then clearly when valuations are lower than before, and then that was then in 23 the case where you saw a lot of internal rounds or convertible loan notes happening. Nobody wanted to accept on the face value a down round, while people try to avoid the topic of evaluation by putting in convertible loan notes. But the good news is that we have seen the underlying assets not only in our portfolio but in many other portfolios that we're monitoring. They have shown very strong fundamental performance in 22, but particular 23. So, which means even multiples have maybe come down versus the years 2020 and 21. They have come up versus 2022 for sure, and also partially versus 2023. And now also the underlying performance, because companies are larger, also more profitable. The slightly lowered multiples work again with the fundamentals so that you at least can get flat rounds or up rounds, while you also will see more rounds happening on the price side. So therefore, and also then coming back to the time lag, I said, also the time lag is fitting in that the new multiple levels of 2022-23 are now really in the market accepted. So, and that all comes pretty nicely together. Why I also predict that we will see in 2020, second half 2024, a way higher activity both on the deal making as well as on the exit side, but with a real year to first call it normalized year in 2025.
That's an interesting explanation, and I think it makes the wording of portfolio construction and portfolio management, let's say, more and more important. So maybe we talk a bit about from your point of view. So how are you structuring, let's say, a private equity portfolio, which is also reflecting to secure that the portfolio is structured well for times like we saw in the last 2 years, but also for the future?
Look, there's you use one wording that is called portfolio construction. I would like to split that in two. One is portfolio construction, and what are the fundamentals of investing? And maybe starting with the latter one. Fundamentals of investing starts with that you can run a very strong cherry pick approach. Means you must ensure that you really see a lot of deals, a lot of companies relevant of size and geography for your fund product, that you can really make sure that you can pick the right assets, and not only pick the right assets, also finally can be able to land a deal at terms that work for you. To give an example or magnitude of how many companies we see per year, we see per year about 1,100 to 1,200 companies in Europe, which we analyze on paper, but of which we about 300 speak to. We issue about 15 LOIs and do out of that 3 to 4 deals. So therefore, if you have such a strong deal flow, you also find still the companies that are prepared to accept reasonable valuations. And as there's sort of long-term data around, which valuations worked in good and in bad times, you clearly try to land your deals very disciplined on the entry valuation around those deals, those multiples and those entry valuations, which work in all times. Work in all times means clearly you make in the right cycle a higher return than in a downward cycle, but you still make money with it. And I think that is also where you see differentiation in the market. You see particularly younger teams that started 2016, 17. They have invested a lot of capital in 2019, 20, 21, and for sure paid to some degree the price today for that. For example, we have stayed very shy at 2020 and 21 with new investments, simply looking at the data that we still go in with our very disciplined entry valuations, but guess what? We lost most deals on valuation in 2020, 21, which is quite frustrating for a team back then. But today, everyone is very happy about it and understands why we did that. So if you don't leave the fundamentals of investing and stay very disciplined around it, and I would say we stay even more disciplined around it today than 12 years ago or 13 years ago when HPE started, I think you can sleep always pretty well, that you at least make a solid or very good return regardless of cycle. With regards to portfolio construction, I think generally where we invest in the phase what many people call scale-ups. Others would call it's Series B stage, Series C stage. How I like to describe it, that everyone understands it, we're investing and we're very good in taking companies from about 10 million euro of revenues to 100 million euro of revenues or larger. And in that stage, you build typically, you should not have a portfolio of less than 6 assets, purely from a risk diversification. But I think you should also not have more than 15, because these companies require clearly some real coaching, some real need for support, etc. And if you simply have too many on a portfolio, I think it's tough to really be close to those companies and really work with them. So in our funds, you typically see, depending on the fund size and the product, and the earlier funds, you see more an 8 to 10 companies diversification, and the newer funds rather a 12 to 14 companies diversification. But what is very important is that we never back two horses in the same sector. So first of all, from a portfolio construction and risk construction, if you have too many horses in the same sector, If something is going wrong in that sector, be it from a regulatory point of view, perceptual point of view, etc., you have multiple assets to immediately call it under the water. Under the water. But also from an, as we said, we really help companies and try to coach them. If I only pick one horse per sector, this one company knows they get all my attention, all my support, and I don't have to divide my coaching among three companies, which might even be at a later stage competitive. And they need to fear I always put my resources there where I see most of the upside. So I think, therefore, making really sure that you have one horse per sector, I think that is in itself a good hedge by means of portfolio construction. And also what we invest pan Western European. So we don't have hard rules around it, but we would also avoid to invest all the money in one country. So clearly the money is typically allocated alongside the size of the companies, of the countries. So you do more deals in Germany than in Luxembourg. I think that's pretty obvious. But we still have normally a very good geographical diversification. So in the mixture of really following the fundamentals of investing, one horse per sector, and also have a good geographic diversification, builds all in all a pretty good natural hedge within the portfolio.
I think what you mentioned with the data is, I think, really interesting. We as Cap Native, we look also on the point of data when we do our due diligence on funds itself. And of course, like the whole hype around AI and things like that is now in everyone's mouth. But when you look back, then you basically see that AI, or let's say data, were used in the past already since years. When you describe that you use the data for finding the right multiples, that you still earn money even in down cycles, how would you see AI potentially supporting or affecting the work of using data already, and how you see that potentially in the future?
Look, I think first of all, AI has huge potential, and I think everyone agrees on it. And I think it's not the theme of this podcast where in the hype cycle AI currently is, if we're beyond the hype or just in the upslope or we're really in the reality phase. And also, I think there's a huge misunderstanding very often what AI is. Most of the AI that is there today is still machine learning and not true AI.
Yeah.
But let's leave that aside. I think if you look in investing, there's different sides or different steps in doing investments. And in some steps, we expect AI to play a huge role, and we, to some degree, apply that already today. And in some steps, AI will never really have a chance to really contribute strongly. Um, what I mean is if you look at that, where we use already some sort of, you would call it AI tools, it's not full AI, I would rather call it machine learning still, is in the deal sourcing. I mentioned we see per year 1,100 to 1,200 companies. If you do that for, I said, 13 years, you can easily do the math. We have a database of more than 16,000 companies. And how do you stay on top of that, of the news flow? Because some companies very often go sideways very long and all of a sudden come to an inflection point where they grow. So we use data tools indeed to define data points, and we grab per day on these 16,000 companies, on average 350,000 data points per day are basically grabbed in the internet, in the public world, and put together then by some smart tooling to sort those companies into what we call a watch list A, watch list B, and watch list C, with watch list A being the most attractive one. What that does, companies typically give what we call growth trigger points. For example, if on LinkedIn someone is changing the bucket, how many employees they have, this is a data point which goes into the software. Or if companies open new offices, that's a trigger point. So it's trigger points beyond purely financial data. As we invest in private companies, they don't publish very often their financial data. But out of all these points, our algorithms get smarter and smarter to identify which company is accelerating its growth by these different trigger points. So I think AI will play in the company finding, deal sourcing, pre-sorting of companies, etc., a very important role. and it does already. We are not the only ones. Many of our friends and peers use also similar tools, but that is still, I think, in the beginnings and will definitely mature and accelerate over the next years. I think when you then look also in some of the due diligence elements, so after you found the company, you do due diligence, you look, do we like the company? You try to really understand it, but also look, is everything clean in the company? Um, and there you have, say, typically six, so we have six due diligence elements. Just to name them, you have a commercial due diligence, then you have a tech due diligence, as we're a tech investor. You have a legal due diligence, and then you have a financial due diligence. You have an HR due diligence, so really making sure, do we have the right people, do we have the right organizational structure? And more recently, so since 5 years, we also do what is called an ESG due diligence. So that is very much going in the, call it, field of impact. So do no harm, but use your business for the good. And I think particularly in the commercial diligence, their AI is also increasingly playing a role, because in commercial diligence, you try to benchmark a lot with peers and competitors, etc. So profiling of competitors is already done today with certain AI tools. And again, putting together growth trigger points of private companies and benchmarking those for your own. We're also analyzing where do customers sit, how fast do they roll on. Customers said AI will play their more important roles. But one element which I think AI, at least for some time, will have difficulties to assess is at the end the human capital. And when there's one thing what we say we need to get right in a company, it's still the CEO and the chairman of the business. So, and that is still, well, how our investors say, the key element, what you as a manager you need to prove, is that you're very good at management team selection. And management team selection is, again, at the end assessing, has a lot of to do with psychology, um, gut feel, spending time with each other, experience, etc. And I think that is where I will for some time have difficulties to truly contribute and to take that job away. But I would say I can everywhere help where you have really the analytical support, also on the financial analysis. And if then the analytical support fits together with what we call HR due diligence, I think then you have a good match. So, and that's the two sides. And then clearly later, when it's about selling a business again, AI can the same way like it can analyze competitors and come up with a list of competitors. It can very much help with making what we call an exit market map. For whom could this business be relevant? So therefore, AI will play a role, but it will not lead to that we can fire 2/3 of our people. It is a very people-intense business to assess people. So, and I think that will at least remain for the foreseeable future.
Yes, I would agree. And really interesting to learn how you use it today. I mean, I'm not sure if there will be any time soon an AI, like, let's say, deciding about people. As long as you have data, I mean, it's a good opportunity. I mean, you could even go that far that you support your HR due diligence with seeing how long are people staying in the company, which also is kind of a reflection about how good the management team is, let's say, working with the employees, right?
Yes, absolutely. Again, everything what you can translate properly to data, AI will play a role. And why management is so important is you have many famous failed tech stories out there where everyone is saying you, but it was the best technology ever in the market. But technology itself doesn't sell itself. It has to do with how do the go-to-market strategy, what price do I put on this product, how is it packaged, what's the customer experience, how well is the service afterwards, how reliable is your entire approach versus why people may rather buy the little bit inferior product, but if they have a better comfort applying that technology. So therefore, a lot of it has to do really with management, and management is really a people's business. And so therefore, that's where we put also lots of emphasis to make sure that the product is also will sell in the future or is even accelerated in itself.
Yeah, agreed. And you have also mentioned, of course, next to the construction and the fundamentals, that you're, let's say, putting, of course, just money on one horse in the market, and then you're supporting with coaching. I think the aspect of investors not just bringing money into the table, so being let's call it smart money and coaching. Maybe you can explain a bit more on how you, let's say, coach the companies once you have decided to invest and you have selected a good management team.
No, sure. Look, the value creation part is actually the most important part that we as an investor can bring to the table. And the good thing is, if we create value for ourselves, we create value for all stakeholders. And that means other shareholders, but also management team, which typically in scale up companies are incentivized also by some stock options or other incentive programs, which are aligned with shareholder value creation. Um, there's two aspects to value creation. There's always what we call the systematic approach to value creation, and there's an ad hoc approach to value creation. The systematic is one which every private equity firm has basically, or most private equity firms have certain building blocks which a company needs to run through. Like we have 6 defined building blocks which a company has to run through, regardless of if they're good or bad in that element. It's just to make sure that we have ticked in each of these building blocks, looked in each of these things to tick the box. Is this already in best state of the art, or where do we need to improve, etc.? And therefore, no surprise, 4 of the 6 building blocks we run in the first 12 months, because you really want to get the company right at the beginning, to prepare really for enormous growth and scaling up. Um, the ad hoc part is simply things we all know. When you have a company or it's something very dynamic, things happen which are not foreseen, which can go from negative to positive. On the negative side, you may lose a large customer unexpected, or all of a sudden your tech platform has an outage for some time. And in some industries, a 2-minute outage is very, very long, right? Or it might simply be that you get a call from a CEO saying, hey, one of my family members got diagnosed with cancer. I want to take care of that person. I'm out as of tomorrow, most likely for the next 2 years, and you need to find immediately sort of replacement. So that is where I think experience comes into play, and there definitely, I would say, I'm a more complete investor today. I'm 50 years old than I was maybe 20 years ago. Even at 30, you think you have seen everything already. With 50, you realize you definitely haven't. So there are a lot of experience, and not only my experience, the experience of the entire team contributes how to handle these things. But I think it's also very important that when you're close to a company and have a real relationship with the management team and the stakeholders, coming back to this active approach of coaching, you can also maneuver much better through the ad hoc portfolio work than when you always just show up once a quarter only to a board meeting. This and then the systematic approach, that is always, we have seen growth companies, as I said, for the last 25 years. I'm in my career, and we're for 13 years at HPE. And growth companies, very often, that's why we focus on a certain stage, and other companies focus on a different stage. Each stage has the same growth pains typically and the same growth patterns. We have done that, seen that several times while we prepare those companies, walk them through different stages, understand where you have low hanging fruits, try to resolve bottlenecks before they even become a problem. And we have done that simply multiple times. An entrepreneur or founder, he might be very good at coding and have a vision for his software product, but he has never thought about, okay, how do I really internationalize? When do I need to switch from an Excel based bookkeeping system to proper bookkeeping software to consolidation software? When do I move from my local auditor, which was maybe a friend of my father, to one of the big four auditors? Which implications come with that? All these type of questions we have seen multiple times. It's my daily job, while for a software founder, it's his job to create a great software and find new features, new tools within the software, and sell it to his customers. So it's just a very different angle. And that's where we leverage in these 6 building blocks. We leverage all the experience we have in the team, we have seen in our career, while we also once a year really take 2 days time to review these building blocks. What have we learned again? Where can we further refine them? And there's many things what simply founders or many people also have not thought about, which are really simply help really creating more value by also sometimes some simple things which people never thought about.
Yeah, I mean, it could be also just the price increase from about like 2.5 to 5%, which is also already creating value in the short term, right?
Yeah, for example, I mean, pricing is one of the building blocks, right? How do I do my pricing model? Because particularly with digital products, you can do pricing very differently. But maybe to give another example, which creates value, where it's difficult to quantify, but it definitely creates value. When we come, for example, with fintech companies, with payment companies, or other companies to an exit window, we prepare companies really from the technology side to be part of a listed environment. And that is called, overall, call it to build an infosec team. Infosec teams are teams that monitor 24/7. Do I get attacked by hackers or not? And where does it come from? And what do we need to do to defend that? When you're a small unknown software company or payments companies of 100 million euro revenue, you have sufficient attacks, trust me. But when you are being bought by the PayPals, the Googles of the world, etc., which are listed, and if they announce the signing of such a deal, the number of hacker attack goes up by about a factor 10,000 overnight. And this is a real challenge for such a company. And this is also a criteria for a listed company. How well is the target prepared? And if we have already an infosec team that is like is if you're in a public environment and can monitor this magnitude of hacker attacks and can defend them, say the PayPal, Googles of the world, Apple would still maybe buy the asset, but when they see that is already they have way more comfort in buying them. And it's a bit like when you, whatever, maybe ever have bought a house or rent a flat, when it's simply well done and high quality and the sun is shining, you like something way more and prepared to pay a higher budget than when it's a rainy day and it's a bit dirty everywhere in the flat, etc. And it's the same with the company. If you give people on top that the analytics work out and they need the product, give them comfort that people have thought about that, they're normally prepared also to pay a premium price for such an asset than when everything is not this type of an order. So, and that's simply where the experience comes in, that the founder has never thought about how do I need to look like in a public environment and why is the buyer thinking about that? And that's where we can come in and help them sort of in the last 12 months of an investment, say, hey, you need to do this, that, and that. That a buyer does not only like you, but he really feels comfortable buying you while he's comfortable paying this extra price that we want to ask from them.
I mean, it's great doing the podcast because some things I can already now start thinking about, right? I mean, of course, not all the 65 points, but at least some important facts are already taken into consideration now. You talked a lot about value creation, and of course, this is affecting paying back money to investors investing into your fund. How important are secondaries for this strategy to sell companies and to let's say bring money back to investors?
Look, to bring money back to investors, secondary is a key tool. Means we sell our shares to someone else to take the money to return it to investors. I think secondaries generally, and we like that a lot. Secondary has become a more important element in the market, and why we like that a lot is very simple. We're a minority investor. For those who don't know what that means, we typically own the company for 10 to 40%. We need to align with others, and we're what I said, a Series B stage investor. I would say prior to 2018, 19, it was very much when you went to a founder, say, we help you grow your business. We're a partner for 5, 6 years. But they always expected us to stay on board for this one big exit. So everyone joined the cap table, but we only leave the cap table jointly and sell the business to a strategic. And this is sometimes clearly difficult for us as a fund because as a fund, you have an end of a fund lifetime and you have to, but you also want to return capital to your investors because that's the trust they've given you. They give you capital and get it back and ideally even a gain on top of that. what has culturally really changed in the years 2019, 20, 21, and we still see that in the market, even not so many transactions have happened. There's way more a come and go on the cap table. So a founder does not see it any longer as a breach of trust if I invest, but in a next financing round, which is primarily around primary, which means money going into the company. But if there's also a secondary element, if I take some chips off the table, say sell one third of my position, I'm still seen as a trusted partner where they want to take advice, where they want to be coached by, etc., etc. While in the past it was really seen as a breach of trust, like, hey, you said you're a long-term partner, how can you sell a share? And that makes it, I think, way more easier, and at the end is also much better for the entrepreneur, also for the entrepreneurship in Europe, because if you have a bit more liquidity in such an illiquid market, I think there will be more money allocated to this market, which at the end builds a stronger ecosystem, and there's more capital available for private markets to build more innovative companies, more scale ups, and drive innovation. So therefore, I think it's very important that secondary has become a more, what is, I would say, standard element in addition to the primary, and is particularly culturally more accepted, which just makes it a bit more liquid market, as said, and therefore way more flexible structures to some degree.
Yeah, I think the the really important point you made was the point of trust, because if you talk to people outside and you say private markets, then I mean the first thing ever comes is the illiquidity. And if you build more trust through like the fact of that secondaries are more and more common as you described it, then people are more likely to say, okay, I mean it's maybe not the typical type of 10 years duration or 12 years duration, whatever. I can maybe get my money back after 3 years, after 4 years, after 5 years as well. Yeah, I mean would be a great development if this continues in the way.
Yeah, and it continues throughout the entire industry. The same way it is more a common goal on the cap table of an individual company, also in funds.
Hmm.
So my investors, also there are secondaries happening. Like my investors, as pension funds have a change in their risk policy, etc. They often sell their position in my fund to another pension fund, to another family office. And also that was in the past and sometimes seen as, oh, he's not happy, that investor.
Hmm.
These days, it's much more about liquidity management, also of these large financial institutions, where they sometimes then simply have to take, because there are changes in risk policy, there are changes, how much are they allowed to allocate to alternatives, and that changes also a bit in cycles. So therefore, also there for LPs, it allows much more flexibility. So therefore, I agree with you. It's still in illiquid asset class. It's still closed-end funds of 10, 12, 14 years. But if you're prepared to say, if things come to shuffle or worst case, you need your liquidity back, if you're prepared, say, to accept a slight discount to where the valuation of the fund or the valuation of the company is, yes, I would say with a visibility of 6 to 12 months, you have chances to get out, which was maybe not possible 10 or 15 years ago. And you have an entire industry arising around that. There's more capital raised at the moment, definitely, or it feels like at least, for secondary than for primary, particularly on the fund side. And you have also more and more what is called direct secondary funds emerging, means funds that specialize buying secondary shares in great assets, so only in the companies directly. They don't even try to put money in the companies, but only what are out there for those who want to exit, who want to create liquidity at a discount.
Yeah, I mean that's a great development, of course. And you mentioned already pension schemes. So let's talk a bit around who are the limited partners, so the investors investing money into your fund.
We from the beginning have been taking a very institutional approach. Institutional for us means at the beginning we were have drawn even a hard line that we don't want to have investors that manage less than 1 billion assets under management. We have softened that over the years. What we wanted to achieve with that is um, we describe institutional capital for us is also what we call a non-emotional capital,
Mhm.
whereby private individuals' capital is very often emotional capital. And so there are also family offices. Why also there that was defined as 1 billion. At that scale, family offices have a professional infrastructure. So the people who work there are sophisticated private equity people who are employed to manage that capital, who are experienced, and you don't work with the principal directly, and don't are kind of more like exposed to maybe the volatile emotions of the principal. But the principal also has established a professional infrastructure which very quietly works through the years of opportunity, the years of risk, etc., etc. And so, therefore, we very much look for, as long as there's a professional infrastructure, we enjoy that capital a lot. So our LPs are pension funds, public endowments, private endowments, family offices, so-called fund of funds. And in theory, we don't have one at the moment. It could be insurances or banks. Banks have generally retrenched a bit from alternatives for regulatory reasons, but that is what our target group of capital.
Perfect. Good. Good explained. And I think the aspect of emotional money and non-emotional money is also quite interesting. Talking about non-emotional money investing in your fund, why should they or why are they investing in growth as a subclass of private equity?
Um, First of all, the same way we build the portfolio construction,
Mhm.
you see that also on the institutional investor side happening. And you have different asset classes in private equity. The largest one is still the buyout sector, but the buyout sector is working heavily with leverage. And you see that in years where interest rates change, such a sector can come pretty quickly under pressure. And we've seen that in the recent years. So that means you try the other asset classes and clearly also, and buyout is very much more typically in what you would call old economy industries because it's about strong cash flows, very stable cash flows, and mature cash flows. So thereby if you go and buyout, you're more in the industrial tech side and you work with leverage. And leverage works positively, but leverage can also work negatively. Then you have, for example, the asset class of venture capital or growth. Growth simply means you work with the companies that venture capital emerged upon, so innovative companies. Both asset classes, venture capital and growth, are normally equity only strategies, so we're not dependent on leverage. Therefore, impact of interest rates hurt us less or to say not at all. So it's an equity only strategy, thereby already a different risk profile. And also venture and growth is more targeted towards the innovative companies, call it more the software and the things what you these days read very often on the front page of a newspaper upon, or the Nvidias of the world, etc. So and therefore, if you also want to have a different sector focus and also have a different risk diversification by means of leverage, non-leverage, you build that into your portfolio. Um, in addition, is that if you look simply at the returns profile, you can say that growth and venture on average is delivering very similar returns than the buyout sector. But venture um, is in both ways, we have to say, more volatile maybe. Um, Volatile means you have the great chance to surprise very positively on the returns. And why is that? Because if you have in a fund, say the Facebooks of the world, these are business models which can scale in 5 years to multi-billion dollar companies. While it's when you're an industrial tech company, these companies can never scale so fast because you have to manage supply chain, build production facilities where you need building permits, all these type of things. So therefore, in terms of the possibility to really build the super winners or the jackpots in the fund, is only possible, say, in the digital world and the fast scaling business model. So also from that point of view, if you want to give yourself at least a chance to knock it out of the stadium, there's no other you have to be part of those asset classes. But to be clear, in venture, therefore, it can also be that when you're the wrong side, well, that you're volatile to the negative side, while also you see also that venture and growth is a smaller part of the portfolio of an institutional investor because it's really kind of more like mixed into the portfolio for the additional alpha. And the selection is very, very consciously done, and why track record really matters a lot. But that's sort of the two reasons or three reasons: equity only, be part of an innovative, kind of more like of innovative technology, and also have the chance to surprise an alpha by means of that you, because these assets scale faster, are all good reasons to be part of that sector. In addition, what we see more and more also with the, call it, impact, social impact, climate impact, and doing good with your money, there's more and more that institutional LPs also really feel a responsibility to use the capital for the good of society. And therefore, there's one sentence that you can say, which is used very often recently, is innovation saves the world. So in terms of, if people take their responsibility to use capital for the good, it's important to help stimulating innovation, and that is happening more on the venture and the growth side of the asset class and on the buyout side. And also that is what we have seen recently is additional motivation for people to come in, which goes beyond return.
Innovation saves the world. I think that's a pretty good end of the episode today. We learned a lot about portfolio construction, how to put your money onto the big winners, and how to support them to become exit ready. Tim, it was a pleasure having you here today. I really enjoyed that, and I also learned a bit about how you do it, and of course also for the overall market. So thanks a lot.
I mean, you're an expert in innovation yourself with the business that you're building. We're big fan of that, a big supporter of that. So therefore, thank you very much for having us today, and looking forward to monitor your own success story, and looking forward to next podcast episodes, which I will definitely listen to. Thank you very much, Philip.
Thank you. So we learned what we need to increase on LinkedIn to become a data point in your storage.
Perfect.
Thanks a lot.
Thank you.
Bye-bye.
Bye-bye.